Great. You're all very welcome to today's seminar on international tax and transfer pricing. For those of you who don't know me, my name is Ronan McGivern. I'm a tax partner in RBK, based around the corner in our Sandyford office. Delighted to be joined today in Dublin by an excellent panel of international tax and transfer pricing specialists. Ben Miller, head of transfer pricing from Bennett Thrasher, based in Atlanta, Georgia. James Parks, international tax partner, also from Bennett Thrasher, and Edgar van Hessel, senior tax manager from Oers in the Netherlands. Just mention as well, Edgar's colleague, Thijs Biljard, who leads out the VAT services in Oers, is also with us locally in Dublin for this event. I want to take this opportunity to thank you all for taking the time out of your busy schedules to come to Ireland to share your expertise with us and our clients. It is very much appreciated. Even more impressive is that we managed to get you all landed in Ireland just between the two storms. So, that was the easy part. The hard part is getting home. So it's no understatement to say that the pace of change in the international tax landscape shows no sign of slowing down. Ireland's economic policy for decades has been based on a pro-business open economy, which in turn has as a core component a low rate of corporation tax on business profits. Ireland is a small open economy and is a member of the OECD and a member of the European Union. Operating in a globalized world, there's been an increasing focus on taxation, where profits should be taxed and what global minimum rate of tax corporates could be paying. When I started my career over 20 years ago, it was all about manufacturing relief, an effective rate of 10% on trading profits. This relief fell foul of EU rules, which in turn led to the introduction of the 12.5% rate of corporation tax on trading profits. That rate was introduced in 2023, 20 years ago, and has been a core part of every government's fiscal policy since. As you can see, changes in corporation tax rates do not happen often in Ireland, so it is worth noting the adoption by Ireland, effective from 1 January 2024, of the global minimum corporate tax rate of 15% for the largest corporate taxpayers. The Irish government estimates that 99% of Irish corporate taxpayers will not be affected. There is no change to most taxpayers. This has drawn a line in the sand about the debate about the rate of corporation tax. However, the story does not end there. There are still a number of initiatives at the EU level that businesses need to be aware of. In addition, the focus is increasingly on the allocation of profits and where profits should be taxed. Ben Miller will discuss transfer pricing, and Edgar will provide an overview of what we can expect to see from the European Union coming down the tracks. Lastly, and by no means least, an Irish politician once described Ireland as being closer to Boston than Berlin in the context of our ties and global outlook. The US is still the biggest source of foreign direct investment into Ireland. This is an election year in the US, and certainly the decisions and policies that will be made in Washington will have an impact on Ireland. Look forward to hearing from James Parks as to what we can expect from the US. So I would now like to introduce Ben Miller to give us an overview of transfer pricing.
Awesome. Thanks, Ryan. Hey, everybody. It's really a pleasure to be here in Dublin with you all at a wonderful event. Ronan, thanks so much to you and your whole team for hosting us here. So let's talk about transfer pricing. Yeah, so Ronan was mentioning kind of as corporations are being more and more global, this question of where profits to be taxed comes up and is more and more, and it's really becoming a focus of tax authorities globally. And the sort of catalyst for how we decide where profits are reported is transfer pricing, right? So first thing I want to do is just give a quick primer on transfer pricing and talk about some best practices that we can all be thinking about as we make plans for 2024 and beyond. And also think about capturing what was happening in 2023. And then I want to give you a couple of brief examples about the interplay between customs and tariffs and transfer pricing. And that gets back sort of to this typical thinking of a manufacturing company who's looking to sell out into the rest of the world. And then you can kind of apply some of those facts in the customs context and compare to the transfer pricing context, and you can see how there's tension between the two. We'll talk about a couple of pitfalls there and some solutions too. All right, so transfer pricing. Transfer pricing is nothing more than setting the price of something that has a value between two or more related entities. And to be a related entity, depending on the jurisdiction, there might be a different definition. Some jurisdictions will talk about ownership. Yeah. So if you look in the Ireland transfer pricing rules, it'll talk about percent ownership of different entities and how they're related in that way. There's also mention of control.
So even though there may not be direct legal entity ownership relationship, there may be common control by some figure or some individual who can control both groups of people. Transfer pricing applies to transactions, or really, I just like to think of value transfers, right? So anytime value is transferred between two entities, that makes a transaction, and a transaction requires a price. That price is the transfer price for transferring the value from entity A to entity B. Goods, services, IP, and the often forgotten financial transactions, loans, guarantees, these sorts of things. Very important. Why do the tax authorities care? Right? Tax authorities tax, well, income tax authorities tax income, and transfer prices impact income. You're setting the price that's going to hit the P&L of both entities, right? So the number is going to be a cost in one and revenue in the other. And it's a controlled transaction. So the company and their advisors get to decide what that number is going to be. And by changing the number, you increase and decrease taxes in each jurisdiction. And so around the world, and I'm happy to say here in 2024, now that Brazil is on board, all of the major trading jurisdictions in the world follow the arm's length standard and the arm's length principles that are outlined in the OECD guidelines. And just to keep in mind, it typically does apply to multinational situations, but it can apply to domestic as well. So more than one entity in a controlled group, right, that's in the same country. So some sort of best practices here, right? Why we care about transfer pricing? I do it because it's fun and I like it, right? But most of you, if you do too, talk to me. There's a good job ahead for you. But in all seriousness, the reason that most people are thinking about it, business owners, right, advisors, is to manage risk. There is income tax risk. It's a real thing. And tax authorities around the world all want to be able to tax profits. And they more and more are going after transfer pricing as a way to be able to capture more profits in their tax net. For the business itself, there's also a sense of competitive advantage or disadvantage. If you're not availing yourself of transfer pricing that is efficient and that optimizes the tax position, you don't have as much money to invest in your future. And you're going to look like this. So what do? We use best practices. The first thing is whenever a company expands into a new jurisdiction and you know there will be value transfers, or if they're assessing their current situation, you got to plan. So don't at the end of the year decide, oh, well, we forgot to do everything. What do we do now? Plan for it. You're expanding into a new jurisdiction. Raise your hand. Yeah, if your clients are going into a new jurisdiction, ask them, how are you doing that? What comes next? Let's think about the transfer pricing for this, so that as the year goes on and as the years go by, right, there's an objective and purposeful plan in place for the transfer pricing. Then every year you need to document it if you live outside the United States, okay? In most countries in Europe, there are statutory requirements to prepare transfer pricing documentation. They are real. Here in Ireland, they begin at entities that have consolidated group turnover of 50 million euro or more. And the requirements kind of go up and up as you hit a 250 million mark and then a 750 million mark. It is what it is, and it needs to be done. Irish Revenue have asked for this starting kind of a couple of years ago. And I think that they will now start auditing them more and more. In the Netherlands, for my colleagues, you're already about 5 years into it, more than that. And in the United States, there's a requirement to price things with the arm's length standard, but no documentation necessary. You just have to defend yourself if you're audited. And what we tell our clients all the time is the best way to defend yourself is to have planned and to have documented your transfer pricing. All right, when you do that, and there is an examination by the tax authority, you hand them the transfer pricing study. We print one side, big font, so it's heavy. Yeah, just kidding, we don't do that. Now they're all electronic. That strategy went out the window, but it is what I learned to do when I started my career. And they look at it and they can see that it's reasonable. And then the burden of proof is on the tax authority at that point under the OECD kind of model convention, right, about having to prove that the transfer pricing is unreasonable. It's very powerful. If you leave it to the tax authority to come in the assessment and say, here's what we think it should be, then the burden of proof is on the taxpayer. It's not a good decision or not a good place to be in. It's easy, plan, document, defend. That's what we do every day. Those are our best practices in the Bennett Thrasher transfer pricing team, and it works. And our clients feel like this, and so do we. All right, no sunglasses here, except for yesterday. It was sunny. It was very nice. I was really happy about that. So, transfer pricing at the end of the day, there are different methods. They're all set forth in the OECD guidelines. You either base your transfer pricing for your controlled transaction on a similar transaction that's observed in the market, or you take a step back from it and you look at the profits of companies that engage in similar types of transactions. Those profits-based methods are way more popular and common than the transactional methods. Interestingly, customs is often based on transactional methods are preferred. Yeah. And in customs, the typical approach is that the transfer price is the customs value. When you use a profits-based analysis to get to a transfer price, it's a little cumbersome, but by and large, transfer price is the same as the transactional value that's used for customs. In a lot of jurisdictions, the sort of legal or the agency that's responsible for customs is the same as it is for tax. And in some it is not. And so there can be divergence there too. It's always something to be aware of. So the typical fact pattern that comes up where there is an issue around customs and the tension between transfer pricing is where you are using a profits-based method and you're trying to come up with the price that your distributor in the Netherlands is going to pay to the manufacturer here in Ireland for a container of goods. And the way that you come up with the pricing is that you look at some assumptions about market pricing. You try to think about how much your expenses are going to be in the location to distribute and house the goods. You think about some risks, maybe some warranties, returns, and you kind of create a model income statement. And the only thing that's missing is your cost of goods sold, right? And then the transfer pricing advisor is going to come in and say, here's what the profit margin should be. Here's that number. And so we do arithmetic and we come up with a number for the kind of container of goods. Does that make sense? It is the solving piece for the equation. As that's best to do that at the beginning of the year. As you go through the year, oftentimes some of these assumptions are going to change right throughout the year. Maybe the market prices change or you have a bad batch of stuff or something. And so the price that you set at the beginning of the year for that container you think is going to be correct ends up being off, right? It can't be 1,000, it needs to be 900 or some other number in order that the profit margin sticks. And the only way that you get there is through adjustments. And so the pitfalls are all around these adjustments. When you have a intercompany relationship and transfer pricing, there should be an intercompany agreement between the two that memorializes the terms and conditions of the transactions, just like if you're dealing with an outside party. The difference is that it's an internal agreement, and we don't always think about all the different kind of clauses and things as if we would if we're dealing with in a commercial sense outside. And so what happens oftentimes is you'll have a company who will come up with the number, the 1,000 for the container of goods. They set it and they just go. And they don't even think about it. And then they get to the very end of the year and they're going to do their transfer pricing documentation and they notice that they're either too profitable or not profitable enough in the distributor's jurisdiction with this profit-based method, right? We're just looking for kind of the profits of companies that engage in similar kinds of transactions. And it can make the transfer pricing a real problem. The other thing that comes up is that there won't be provisions in the legal agreement to make an adjustment. And in some jurisdictions, you have to show an agreement to get the foreign currency to pay or to receive and to make the adjustment, and then you can't. So kind of going through these, and these will be available afterwards, so you'll be able to see. What's really important is when you're doing your transfer pricing and you get the transfer pricing study and you've developed your policy, put it into an intercompany agreement, and then treat that intercompany agreement just like your other commercial agreements. Review them, check that you're being compliant with them, update them when necessary. And if it's for transfer pricing, please include a clause in there saying that there can be adjustments as needed to maintain adherence to arm's length principles. It's often not in there. And when there is no provision in the legal agreement, you get in a lot of trouble. I'm going to just take the last minute here to focus on this. It's very common for many, many years for companies to try to kind of sell through goods to a distributor at a lower price to keep their customs down. And then they would charge a royalty, a brand royalty or something separately. Also, when there were patent box regimes or IP box regimes and you got almost nothing tax rate, right, on your IP income coming through, this was a common thing to do. It's a huge pitfall. It's not good for transfer pricing. And it's not good for the customs value, the transactional value for customs. You're going to be underreporting on customs and your transfer pricing will be wrong. And at least in the US context, what often happens here is that the IRS just disallows the royalty completely. And that's a bad position to be in. The OECD guidelines advocates a similar approach, right? Intangible value should be embedded in the good that's being sold. So the solution's pretty easy. You just include the royalty value in the amount of the good that you're selling. A lot of times these days, the kind of common goods that are transported, at least between Ireland, the US, Netherlands, there's not huge customs duties. Those often come from other jurisdictions. So you won't be paying a lot more customs if you increase the transactional value because the custom rate is very low, and then you're going to be compliant with your transfer pricing. That was a lot. Transfer pricing again, right? We're just coming up with the value of something that is transferred between two entities in the same group. That's the transfer price. It goes into an income statement. And at the end of the day, how that flows through to the taxpayer is not always as intuitive as it is to me, where profits go up and down and we get more efficient, right? And my partner, James, he's really good at saying, well, Ben, I know that it does this and you think that, but after you think about this and that and the other, the end tax result's not as rosy as you thought, Ben. And so James is going to come up now and speak to us a little bit about what's going to be going on in the US sort of over the next little bit. But I'd also would just encourage all of you, as you're thinking about transfer pricing, it goes hand in hand with international tax, right? And you can't treat them separately. And so I'm fortunate to get to work with James because he helps keep me in line that way all the time. So with that, my partner and the head of our international tax practice in Atlanta, Georgia, James Parks.
First, just thank you everybody for coming this afternoon, and Ronan, to you and your team. This has been awesome. Really appreciate all the help and hard work. And to kind of start today, I know I'm supposed to talk about what's happening in the US. I just kind of have a story that I used to tell my daughter when she was like 5 to kind of give you guys a view of how the US in general kind of looks at things. So I used to take like 3 objects and I put one in the middle that was supposed to be the sun. And then I have my daughter and the moon, and I'd have her kind of go around. I was like, this is how things really work versus you in the middle and everything kind of rotate around you. And if what's going on in the US right now is kind of the general view is, well, we're here and everybody else can do around us and whatever we want to do stands. So still to this day, she probably doesn't get it and she's 15 and we don't get it as a country anyway. So just kind of starting with that. So, you know, things are global here and that's kind of what I want to talk about. Just some US tax updates. So for example, the first thing I'll talk about today is our Corporate Transparency Act and beneficial ownership reporting. You guys have been doing this for years. In the US, this is something that's like a new novel concept that everybody hates. Everybody's suing over. It started and they're still suing over it. The small businesses are saying it's too burdensome. We don't want to tell you that information. We'll talk about why in a second. The Tax Cuts and Jobs Act that was put in by President Trump, who will maybe President Trump again, we'll see. But the temporary provisions are expiring. I'll explain why that is and the big impact it has and what may be happening. Bipartisan tax bill, they actually work together to do something. We're not sure it's going to go through or not, though, because the Republicans still have the House and the Senate's 50-50, so they can't really get anything done. And then the presidential candidate comparisons, I only put President Trump and President Biden in here because I think that's how it's going to end up. And certainly after what happened last night, kind of tends to be in that direction. There won't be many changes for President Trump because all his stuff is still there because unfortunately for President Biden, he hasn't been able to get anything done over the last 3 years. So that's kind of where we're at. So the CTA, basically what that's requiring is, and this is new, just started this year, for any US entity that has less than 20 employees makes less than 5 million US dollars or and is registered to do business in the US without a physical address has to report all kinds of information to the government, put this information in a governmental database that right now is not public. Now, I have a feeling that will change. All it takes is a few people to sue the United States for you and get access to it. So for companies created before January 1st of 2024, you have to put your company information and beneficial owners. And for a lot of our inbound clients, they don't want to give their information to the U.S. tax authorities, but now they may have to, depending upon what their ownership is. And that includes kind of passport identifying information, scanning a picture of the passport, all this stuff kind of has to be uploaded in. And when I say for many of my clients, because we have lots in South America and Panama and jurisdictions like that the U.S. hasn't traditionally had a good relationship with. And you have to report anybody with substantial control. For companies created after January 1st, you also have to include the company applicant. That is generally the law firm or the attorney who created it. The theory behind that is if the government is doing this under the premise that people are money laundering and arms trade and all kinds of stuff through U.S. companies. And so we want all the information as much as possible on everybody. And so that they've given you 90 days for all new entities this year. And then you have to the end of the year if it was before January 1st of 2024. It's a big deal for a lot of our clients. As I said before, you generally haven't had to report this. Even if you went to go get a bank account, you generally didn't have to give this much information. You know, the U.S. is a very private society. And so it's a big deal from that side. So the TJCA, the provision sunset. So this was the tax law put in by President Trump at the end of 2017. And just to kind of give you guys an idea of why this is happening. So in the US, for any kind of economic laws, you have two ways to pass it. It can go through the House and the Senate, or one time a year, you can use budget reconciliation. And what budget reconciliation means is that the Congressional Accounting Office looks at the bill and says, over a 10-year period, it's revenue neutral. And you can use that once a year. That actually went up for a fight last year because President Biden tried to use it twice. But what happened as part of this, I'm sure everyone from an international perspective is aware of our GILTI regime, where we tax subsidiaries of U.S. companies that operate in other jurisdictions. As a C Corp, you used to get a 50% deduction against that income. So at the end of the day, it's kind of cash neutral. Well, that deduction is ratcheting down. So next year, it'll go down to 37.5%. We also had this FDII deduction that is going to also decrease. And part of that is to generate more income over the 10-year period. This is going to come up for debate again. And I'll talk about it here in a few minutes. President Biden has really been harping on getting a lot of these provisions, getting rid of them. He hasn't been able to do it. And especially if everything flips back, you might see a lot of this stuff extended. So if you have any clients operating in the US, I know I have several outbound into Ireland where they rely on this 50% deduction that's going away. So just want to make everybody aware of that. Some other things that have changed. So as part of that, and this is a big one with Ireland, this R&D capitalization rule, section 174. What it has said is basically if I have R&D spend that doesn't qualify as an R&D type credit in the United States, that I have to capitalize those expenses over a 5-year period and amortize. If I do it in a foreign sub, it's 15 years. Congress is looking at changing this as part of the bipartisan bill, but they're still not giving you the full-on deduction in your foreign subs. So, for example, I have several UK clients that do R&D. So now when I, with Ben, he prices out what that should cost. So we pay to UK company. The US would deduct that, except now this law says I couldn't. So I had to capitalize that. And then I have to, our UK company pays the R&D, and that's a deduction in the UK, but the US says, well, no, I have to capitalize that over 15 years. And so I end up kind of picking up more income than I need to. And that's part of the whole America First thing that I went back to, because they don't want you to offshore that R&D. So that's kind of why that rule is into place. So now they're coming back in and saying, well, we will repeal that on the domestic side, but the second you offshore it, you still have to amortize over 15 years. Bonus depreciation, 100% bonus depreciation for property placed through 2025. They're going to reinstate that. So that's a big thing kind of for investment in the US. Other provisions. So it looks like we're going to have a tax treaty with Taiwan. So that's going to go over really well with China. Increase the small business expensing limit. And then this is a big one. As everybody knows, the US is really big on reporting and fines and penalties. And so they're going to increase the dollar amount for payments to independent contractors. And believe it or not, you may see that a lot as you're coming into doing business in the United States, because we always tell our clients, until you get traction, use independent contractors and things like that to try to make sure, you know, you can gain market share, make sure it makes sense from an economic perspective. And so there are some reporting requirements, even on inbound companies, to comply with that. Other updates. This is actually a real big one in the digital realm. So cloud computing, digital services, one of the biggest arguments that everyone has traditionally had with the IRS is whether it's actually a sale of a copyright article versus a royalty. As Ben was mentioning earlier, you know, you have to have the transfer pricing right on a royalty, and then it's subject to withholding tax. If you actually sell the copyright, then it's not subject to any kind of US tax. And so the rules on that are very confusing. So they are supposed to clarify that. And it's a big deal for a lot of our inbound clients. The other one is this receipt of digital assets. So I'm not sure how much you guys have experience with crypto. I have several clients in cryptocurrencies. This is a big deal for them reporting. And then the other one is the corporate alternative minimum tax and the undertaxed profits rule, especially with the OECD. The US is I'll just say we've been kind of retaliatory on a lot of this. And so there's a bill in Congress right now that's basically says, or they're trying to push through, for any country that will charge a US company under this undertaxed profits rule, we will raise the tax rate on all of your companies from your country, plus any individuals who are here in kind of response. So that is sitting in Congress. I don't think it's going to go very far, but you never know. So, and then as I was mentioning before, and what everyone wants to hear about is what will happen in the election. If history tells you anything, we'll probably have President Trump again, just because of how things go back and forth in the United States, but that's just pure speculation. Who knows what will happen between now and then. So President Trump wants to maintain everything he has. I mean, he got that in there before. Ironically, I thought it worked really well for the US economy. Spurred a lot of investment. But President Biden, if this looks familiar to you, because it's what he had 4 years ago, hasn't really changed it. Hasn't really been able to push it through. But he wants to raise the rate to 28%, increase the global low tax intangible rate to 21%. So essentially go back to the old system we had pre-2017. Expand the net investment income tax. I can't tell you how many clients we have invest in the United States that don't know anything about that. And that's a nice 3.8% tax hit on passive type income. Long-term capital gains, he wants to change that rate. Tax carried interest. We have a lot of inbound investment where we might have fund managers and things like that have carries. And so before you used to be able to get that at 20%, he wants to put that at ordinary rates. So that'd be at 37. And then a minimum effective tax rate of 20% on unrealized capital gains. And he's got a big focus on, net wealth above 100 million. I'm sure that number would come down if he could potentially push that through. And so just to prove everything is not so US centric, have Edgar come up here and talk a little bit about what's going on in the Netherlands and the EU.
Yes, thank you, James. First of all, I would also like to thank Ronan and his team for having us over here. We're very proud to be today on this webinar/seminar. As mentioned, I'm going to discuss some recent international EU and tax developments. The EU has dropped a lot of proposals recently, which at first stage might have a specific impact only for the very big multinational enterprises. But as you will see during this short presentation, it might also impact the small and mid-sized entities. So the increase of positive EU law is expected to continue and will have more effect, more than we think, for more companies than we used to think. A brief table of contents. They recently dropped the transfer pricing directive, the BFIT proposal. A while ago, the Unshell proposal, also known as 8083, was dropped. We have the FAST proposal. We have ESG reporting. CBCR is a known phenomenon for a couple of years, but for this year, the CBCR reporting will become public for big companies. There has been agreed on the cross-border teleworking system within the EU. We have the directives DAC 6, 7, 8, and maybe also 9 in the near future. A short update on the Pillar 1 and Pillar 2, which is also briefly mentioned by James. And we have some conclusions to end this presentation. The first one, the EU directive on transfer pricing, was proposed on September 12th last year. And the aim is to integrate the key transfer pricing principles into hard EU law and to make sure the arm's length principle is also used within the EU. If all member states agree on it, it will be applied as from January 1st, 2026, which is pretty soon. Some key elements about those transfer pricing directive is the definition of associated enterprises. It will be based on management position and influence and ownership rights of even more than 25%. So you will become considered as an associated enterprise rather quickly. A positive part of it is the fast-track procedure for resolving double taxation. Under current double tax treaties, if we have a dispute with two tax authorities which don't agree with each other, we will have to start up a mutual agreement procedure, which might take over years before you have an answer in which both tax authorities rely. So the fast-track procedure, which promises a solution within 180 days, is a big improvement. Another typical element is that a jurisdiction can impose a downward adjustment and should inform the other state involved to put a contrary correction to make sure there is no double taxation or no tax leakage. The most appropriate transfer pricing methods from the TP guidelines, which were briefly mentioned by Ben earlier today, will be implemented. And they will also make use of the interquartile range. If the outcome of the result is out of the interquartile range, the jurisdictions might have the right to put an amendment and to keep the median into it. Another typical element is that there should be sufficient TP documentation, also mentioned by Ben. As I understood, in Ireland as well as in the Netherlands, you are obliged to write a master on local files when the consolidated group turnover exceeds the 15 million euro, which you will realize pretty quick if you look at the consolidated results. Another proposal is the BFIT proposal. Years ago, the European Union has also proposed the common corporate consolidated tax base. Well, this is more or less the same. How does it look like? The idea is that a BFIT group should be defined, and a BFIT group will be determined based on ownership. 75% ownership will make you part of the BFIT group. This new BFIT rules will become mandatory for the big taxpayers, which are the taxpayers with the consolidated turnover exceeding the 750 million euro, which is an amount which will come back later in other EU proposals. But it's also mandatory for non-EU headquarters, for instance, the US. If the EU part has at least 50 million euros, which you will realize rather quickly, or the revenues are at least 5% of the total group revenue. Groups which are not mandatory under BFIT have the option to use it, with the only provision is that there are consolidated financial statements. Well, the tax base will be based on the accounting net income with some specific adjustments. And how will the BFIT work out? Well, at first you will have an aggregation, which means the results of all the entities which are part of the BFIT group will be aggregated. And the second step is an allocation of that amount. And the allocation will take place using a 7-year transitional allocation rule based on the members' weighted share. And that members' weighted share will be determined based on several topics like number of employees, intangible assets, turnover, profit level of the past years, and things like that. Very technical formulas will be introduced. What's the how do I say it? A little bit a specific part of it is that after the BFIT calculation and aggregation, so an amount is being attributed to a country, well, this is your part, you can tax on this part. There may be some specific deductions or tax incentive to be determined by the member states itself. A big advantage for BFIT is that you can use cross-border loss relief, which we don't have until now, but it should be in the future. And there will be no withholding tax on intra-group interest and royalty payments. However, a difficulty could be that if there is a multinational group which has some participations which will qualify for BFIT, they can use the BFIT rules. But what to do with subsidiaries less than 75% which are not under BFIT? They will still have to deal with the local income tax filing obligations. So it's interesting to see how that will evolve. Another one is the head office tax system. It's more or less comparable with the BFIT proposal, taking into account that the head office tax system will not be applicable for companies with subsidiaries, but for companies with foreign permanent establishments. More or less the same as under BFIT, it will have the option to file one income tax return in the state where the head office is situated, so that the legal entity is situated, and to file only one tax return. And that member state where the tax return is being filed will share the information with the other states where the permanent establishments are established. Specific thing to mention is that despite the fact there will be only one tax return to be filed in the state where the head office is situated, all member states will be allowed to do a tax audit on their part. The Unshell proposal, this is a proposal which has been first dropped a couple of years ago. The idea is that they would like to make an end of holding companies without any substance, which are only structured into a group structure to make use of tax treaty benefits. So you should look at the substance requirements of those companies. If, for instance, a Dutch holding company doesn't have a bank account, it doesn't have any local employees, it doesn't rent a premises, it will be considered as a shell entity. I have an example on this one. We have a common structure. We have the US. They use a EU hold company with several EU operational companies. If this operational company will pay out a dividend to EU holdco, it would be tax exempt for dividend withholding tax purposes. Due to the good treaty we have with the US, at the end, the dividend could be paid out from EU opco to the US without any dividend withholding. Under the Unshell proposal, if it will be implemented as proposed, EU holdco will be ignored, which means you will have to check what would be the dividend withholding tax obligation for the country where EU opco is situated for a direct dividend payment to the US. Then we have the faster proposal. This is a proposal which mainly will cover investments instead of participations. Under the current situation, if a person living, for instance, in Ireland invests in an instrument in the Netherlands and will receive dividends or interest throughout the Netherlands, one should check whether the Netherlands itself has a national withholding tax regime, and they might be entitled to withhold with dividend withholding tax. The next step is that you should check whether there is a double tax treaty rate between the Netherlands and Ireland to check if they are allowed to withhold at a lower tax rate. Under the faster proposal, the withholding tax relief will be harmonized, which means it will be a lot simpler to use the lower double tax treaty rate instead of taking into account the full procedure, because normally you will have to fill in some forms, have it stamped by both tax authorities, send it out to the tax authorities, and it could take a year before you will get a refund of the dividend withholding tax, which has withhold above the double tax treaty rate. So under the faster proposal, it would lead to a quick relief system. So that's also a very big improvement if this proposal will be implemented as such. Short about some ESG and Fit for 55 program, also due to the time we have. Environmental, social and government reporting obligations. CSRD is effective from 2024 for the big listed companies. However, also the small and mid-sized entities will be influenced by this directive. The idea is that the non-financial information will become as important as financial reporting. I've read in the Dutch newspapers, I think it was last week, that the entities under scope, almost 60% of them has not yet started with the CSRD obligations. So there's really a lot of work in that field. Fit for 55 has the aim to make Europe climate neutral by 2050. Country by country, briefly mentioned before, the normal country by country reporting obligations have started a couple of years ago for groups, multinational groups, which consolidated group turnover exceeds the 750 million. Those companies should provide the tax authorities in their home country about the nature of the activities, the number of full-time employees, the profit and loss, and accumulated and paid income tax and accumulated earnings. So far, so good. However, as from this year on, those country by country reporting should become public, which means big M&Es should publish the contents of the report on the internet using a common template. It is mandatory for the EU headquarters multinational entities, but also mandatory for the non-EU headquarter M&Es which meet certain conditions. It starts for reporting years which start after June 22 this year. So for most of the entities, it will be 2025. EU developments. Due to COVID, teleworking started to become more and more acceptable. Under current rules, one is socially covered in the country where the employer is established. However, if one works out of his home office for 25% or more, the social security shifts to their home country. Under these new rules, teleworkers are entitled to work up to 50% in their home office without any impact on their social security position. Important to note is that this framework only applies for social security, so not for taxes. For taxes, one should check the double tax treaty. The directives on administrative cooperation, just regarding the time briefly, DAC 6 is a spontaneous filing about potential aggressive tax arrangements, with the remark that countries look different at those type of potential aggressive tax arrangements. In our practice, we've had some situations under which the Dutch tax authorities state a specific transaction as to be potential aggressive tax arrangements, while the Belgian authorities specifically excluded it as a potential aggressive tax arrangements. So what should one do? DAC 7, the digital platform registration. There needs to be a filing over book year 2023, needs to be done before 2024, January, for the end of this month. So this becomes very urgent. We have the DAC number 8 that will apply for cryptocurrency. It would make sure that tax authorities will be informed about persons holding crypto assets, because up until now it's quite unclear who holds which assets. DAC number 9 with a question mark behind. During the discussion of the Unshell directive, one of the ideas was what if we could drop down the ATA 3 Unshell directive to a DAC 9, meaning that tax authorities should inform each other about such shell companies. Pillar 1, it is digital service tax for the real big guys, for the Googles, the Facebooks, the Yahoos, which will lead to any taxation in countries where they don't have physical tax presence now, so no permanent establishments, no legal entities, but they do realize profit in those countries, and the idea is that they should be taxed for that. Pillar 2, already mentioned by James briefly, the global minimum taxation. If I'm correct, Ireland also raised its corporate income tax rate to 15%. It should be no coincidence that this will relate to the implementation of the global Pillar 2 minimum taxation. How does that work out? Well, basically, once you check if all entities within the group pay an effective tax rate of 15%, and if they don't, in this situation, Holdco will have the right to impose additional tax to make sure that the group as a whole pays at least 15% corporate income tax. Some conclusions. As I started my presentation, it looks like the most new EU proposals will only have effect on the big companies, but it will also impact the small and mid-sized entities. Not only because the critical amounts tend to decrease, but also a lot of our clients indirectly are part of such a multinational group. And therefore, it's more and more important to follow up on the proposals and see what ideas will be implemented and which will not. That's about it.
Yeah, thanks. Thanks very much, guys. Very, very informative. Just wanted to have a bit of a panel discussion and talk to some views. So Ben, maybe firstly on transfer pricing. As you know, Ireland introduced formal transfer pricing, the new rules relatively recently, documentation, local files and master files. I expect to see quite a bit of revenue intervention this year with a number of years filings. What can taxpayers expect to see, or what's their best position from defending those positions when they get knocked on the door from the Irish revenue?
Yeah, I mean, I think sort of going back to the story before, what they can expect is that there will be a request for a transfer pricing study, and either in the first layer of the information request and certainly in the second coming from Irish revenue, that will be asked for. And so what's important is before the question comes that, and now's a good time, having a year having just ended, is to take a look at the transfer pricing and to confirm that you are following a policy that is arm's length, right? And you're kind of doing the right thing and you're checking it. I don't think there's any sort of secret sauce or anything magical to how to do it, Ronan. It's really just being attentive and to make sure that you're following your transfer pricing strategy that you planned and that you do have proper documentation to hand over, because it will be requested.
Yeah. Thanks. And Edgar, obviously, maybe picking up on the Dutch side where there has been transfer, it's more newer for Irish perspective. What has been the Dutch experience, or what have you seen from the Dutch authorities in the context of transfer pricing audits?
Yeah, what we've seen by the Dutch tax authorities is they start asking for that documentation more and more. Fact is that in the Netherlands, we have a relatively low border to have that documentation obligation. It's 50 million consolidated base, while other countries look at the domestic turnover, which is lower than in these cases. What we also often see is that if a foreign entity wants to start a business in the Netherlands, they say we're a startup company. So they say, well, the company suffers some losses in the first years. That also triggers the tax authorities to put some questions about what's your transfer pricing policy. We always recommend our clients to make sure if you start doing business as an existing foreign entity, but you conquer the Netherlands, make sure that the costs are at least covered, charged. So the Dutch entities presents a small profit instead of the loss in the first years, because loss-making entities which are held by foreign parties are the first one which are under the scope of transfer pricing investigation by the Dutch tax authorities.
Yeah, thank you very much. And James, maybe back to yourself. A few years ago, or maybe about 5-10 years ago, the focus was all in the US of corporate inversions, accessing and going abroad. What's happening now, or what's in the US or politics?
Yeah, I mean, there's still focus on inversions. You know, the policy under President Trump, and it's kind of continued, as I was talking before, has been America first. So it's, you know, the U.S. wants to make sure they get their last bite of the apple. So for those of you who aren't familiar, the inversion rule basically states that if you have a number of U.S. shareholders taking a company abroad, if the ownership doesn't change sufficiently, you're still a U.S. company for all purposes of the U.S. tax code. And so that is still being rigidly enforced by the IRS. Interestingly enough, they're kind of moving that focus onto individuals now too. They changed in the past few years kind of our expatriation rules to make it harder to get out. And so kind of the U.S. enforcement mechanism, especially for U.S. citizens and companies, is kind of ever expanding.
I think maybe just to jump in, James, one of the things that's been sort of interesting that we've seen actually is the reverse. Yeah, where companies from outside the United States are looking to make the US their home base, and you know, either to take advantage of some of the tax benefits that are up there, but also to access the capital markets, right? And to be able to have the company housed in the US and maybe potentially go public there or what have you.
Yeah, I've seen that a lot recently too, with a lot of bioscience companies trying to get patent protection in the US and things like that, and access the US pharmaceutical companies.
That's interesting. Yeah, and certainly the trend, we're seeing a lot more Irish companies and probably from the Netherlands accessing the US market, etc. What about the context? A piece of generally I find, James, and you might have seen as well, sales tax, or companies selling into the US and thinking I'm based in wherever, easy. Do you want to pick up on that, or that's that?
Yeah, that's more and more difficult. You know, it's been a big area of focus. We do a lot of transactional work, and I can't tell you for how many companies are surprised, whether it's a foreign seller or US seller, or what the liability is. And the states are starting really to hone in on that. And you can easily be subject to sales tax and kind of be caught off guard on it, because the nexus or selling into a particular jurisdiction, especially after the Wayfair case, really gave the states a lot more leeway to be able to enforce and kind of collect back taxes.
And so you say for foreign entities selling in, it's something certainly to have on the radar for
definitely. I mean, a lot of times that may be the only tax that a foreign company is exposed to because of treaty protection and things like that. And
then Edgar, this year, obviously we've talked about the election. You know, there's only one election in time, but it's been in reality from an Irish perspective. There's election, and where we see move towards what we call Sinn Féin, or the extremes. The Netherlands, we're reading a lot more about, you know, right-wing governments coming in, and for us, we see the Dutch as a beacon of, you know, liberal sort of pieces. And even there lately in Germany, we saw the concept of Dexit and the AFD. That move to the right, but within the Netherlands, do you see much change or antagonism towards the European Union, or that, or what's the feeling on the ground?
Not really. I think the biggest discussion in the Netherlands is about immigration and about environmental pollution. I don't see any direct influence on tax or leaving the EU or things like that. I think we are most of the EU proposals have been implemented in the Netherlands. We always want to walk up front. We want to be one of the first implementers of those proposals. So I don't see any big impact on tax. Taxes.
No. And obviously, James and Ben, the outcome in November is going to be keenly anticipated right across the world, you know. And so, and it's interesting seeing the tax policies. And one of the pieces that always gets me is that it's seemingly inability in the US to actually get legislation over the line, and the constant struggle of, you know, legislation almost on the books, and how the challenge it must be for tax advisors in that space.
Yeah, I mean, it's been difficult over the last few years. Like I said before in the presentation, they've been using budget reconciliation to get a lot of things through. And it makes it more difficult in a planning perspective, because I can tell you, back in 2018, when we saw how the GILTI provisions and things were going to work, we're planning a 50% deduction. Your clients kind of get used to it. And now we have to have the conversation, hey, that's about to get ratcheted down, and help them plan from a liquidity perspective. And it's really difficult because, this year, I think we have 33 Senate seats up, which they're saying maybe only 3 or 4 flip. So it's been so close. So to be able to kind of plan for what happens beyond this year is tough.
And Ben, sometimes just when we pick them up the transfer pricing again, it can be seen as a rigorous compliance exercise, something that must be done, more administration. But maybe talk to me, one of the things you mentioned again, and what sometimes in the context of planning and opportunities that transfer pricing brings for clients that are willing to think more strategically.
Yeah, so there is a compliance aspect to it, and that does need to occur. Yeah, and that's by law. That being said, and especially when companies are thoughtful in their planning, you really can drive pretty strong benefit through transfer pricing, either by finding ways to structure transactions to minimize global tax burden, or to create a supply chain where maybe your customs duties might be a bit less, mobilizing cash. We've had great success over the years as we deliver a deliverable, our reports out to our clients. We also say, hey, here's our recommendation, and here's 3 other things that you could think about, or ways to turn the dials to really sharpen the advice. And in doing so, we can usually help the client to save some money, but also to be able to sort of meet their kind of global strategy, whatever that might be. And so that's something we like to learn about. Transfer pricing really does become part of the fabric of the company as you go through it. So there's real cash benefit often actually to a transfer pricing exercise.
Absolutely, that's what I say. And James, one of the things obviously is you can see, we don't like to change tax rates in Ireland. We certainly like low tax rates, and often copper is never better, But from a foreign perspective, and the US investment and the 12.5% rate, the first thing people when they ring me talk about is tax rate, etc. How is that still important from US investors going overseas, or from our perspective, it's important we maintain competitiveness. But what are US corporates looking at?
So it's interesting with the tax rate, because of the rules we have with the change in the tax regime, where the US is taxing everything more on kind of a quasi-territorial basis with GILTI. We have this, what we call a high tax exception. So if you go into a higher tax jurisdiction, you can make that election, and then you don't pay any incremental US cash tax until you wouldn't pay any US tax until there's a distribution of that income. So and what I'm seeing from my clients, that's almost secondary to VAT and indirect taxes, because that's actually a legitimate cost for companies going in that maybe haven't set up an established entity or can't take advantage of the input-output system. And so I have a lot of clients focused on that, because that's the cost of the business.
So the headline corporate tax rate is not the be all and end all as it once was for business. Okay. And Edgar, obviously the Unshell directive, and traditionally, I've been working on this for a long time, and like yourself, the best holding company location was the Netherlands. It's the second best place in the world. I remember that video. But these concepts of what we've seen in the past, how have they impacted on the Dutch, psyche, and how have Netherlands pivoted from holding company finance functions and those flows of?
I think the position of the Netherlands have changed due to a pure holding company. To use the Netherlands as a pure holding company, it's getting more and more difficult, because we have to deal with tax authorities which don't provide VAT numbers for substanceless holdings, but also with banks. For a holding without any local staff, it's very hard to obtain for a bank account number. So I think we should aim, if we have a holding function, make sure there's also sufficient staff, there is an office space. Give it some more body to make sure you will obtain the tax numbers, and also the bank account. It will not be any problem.
Yeah, so that's what we're seeing as well from our perspective, aligning your commercial substance with your tax strategy within commercial substance. If the first question is what's the tax, this is done for tax purposes, it's off the table. What's the commercial driver for every one of these? Okay, guys, listen, I think that's everything, and I just want to wrap up. So hopefully this was of interest to everybody, and hopefully you all got something out of this. I want to finally say a massive big thank you to Deirdre McElroy on behalf of all of us here.
Yeah.
The amount of work that Deirdre's done on putting this together. So Deirdre, it wouldn't have happened without you. So thank you very much for this. And again, I want to thank all the guys coming across to Ireland, you know, and my LEA colleagues. It really shows the collaboration that we have. And, you know, when I asked the guys, would they come over? Not a problem. It was when can we get this done? So thank you very much, guys, for taking that time out and giving your time so freely. Thank you. Okay, thanks. Well done, guys. Well done.